give you the reminder again. Please have your notepad next to you so that if there's any query that you want to ask, you can just jot it down first. In order for us to be able to complete our full discussion, may I suggest that maybe at the end of half an hour or after completion of one session, then I'll ask you all if there are any questions. Yeah, that way we can progress a bit faster and complete what we are supposed to complete. Yeah. So I'm going to jump into that Excel worksheet that you already have. I hope you had a chance to take a look at it. And the first phase of our discussion this afternoon is I'll give you an overview, a feel of what financial analysis is all about. And then we will apply the ratios to the case study that we have started discussing this morning. And that is the financials of KLK, yeah? KL Kapong. So let me jump into that now. I'm going to start sharing my screen. This one. Okay, there we go. I told you this is just a working example of one of the retailers, yeah, in Colombo, in Sri Lanka. And we are going to discuss this in 5 areas. Yeah, 5 areas. This morning we focused our attention on what kind of reporting we should do to people who have put money into the business. Yeah, what kind of reporting? Well, people who have put money into our business, they want to know how did we use that money to buy business assets. Who else put the money into the business? So the money that shareholders put into the business, we call it equity. The money that other people put into the business, we call it liabilities. Equity and liabilities becomes the total money, and then we show how we actually use this money to buy assets. And the logic of the statement of financial position is this: if I show you 100 million of assets, I must explain to you who put in the money to get that 100 million worth of assets. Yeah, that's the statement of financial position. Then we looked at the statement of profit or loss, and statement of profit or loss makes you realize that you don't have just one definition of profit. Your profit can be a gross profit, your profit can be a operating profit, or it can be a profit after tax, yeah, or what we call profit for the year. And then we of course looked at the statement of changes in equity and the cash flow statements. The information that you need to work out ratios comes mostly from 2 statements. Yeah, it comes from the statement of profit or loss as well as the statement of financial position. These are the 2 statements that are mainly used for this information. Of course, not all information you can get it from there. Yeah, some of that you will have to get it from the market. So you may actually have to look at market information, stock market information, especially when it comes to share price and things like that for listed companies. Yeah, and that's one thing. The other thing is, it is always a good idea to get a good feel of the industry. Yeah, before you jump into doing any kind of analysis, it's always a good idea to get a feel of the parameters and the environment in which your analysis is taking place. So for us, because you are basically conducting a study in social science, that's what financial management and analysis is all about. Because you're conducting an analysis in social science, you must also therefore understand the business environment in which these businesses that you're going to talk about operate. And then the other thing is, whenever you do the analysis, there must be a specific question that you want to answer. Yeah, and if you can answer that specific question as accurately as possible and as well defined as possible, then you have achieved your objective. Now, is it possible that sometimes people may work out a certain ratio, and they may give the ratio a label the same as what you have done, but they work out that ratio with a slightly different formula. Yes, of course there is. So what I'm going to do today is I'm going to share with you a formula of most of the popular ratios as we use them in practice. At least in my firm at Harvey Gill and Associates, these are the ratios that we use. These ratios are based on the CFA Institute's definitions, yeah, that is Chartered Financial Analysts. At this moment, I think on planet Earth, the Chartered Financial Analysts are the authority, yeah, on financial analysis. So I think it makes a lot of sense for us to look at what they say, yeah. Okay, so that's the baseline. Also now might be a good time for you to have your calculator next to you, because for this afternoon session you will need your calculator to check on some of the maths which I'm going to do and demonstrate. Okay, let's jump into this straight away. The first area of analysis is we want to ask ourselves, what is the rate at which the company makes the profits? So what is profitability all about? Profitability is about rate of profits. Yeah, this is a rate of profits. We know profit simply means income minus expenditure. We know that, yeah. But we want to know at what rate we earn income and profit. Of course, our analysis must start with income, with revenue, because no income, no profit. Yeah. So when we look at profitability, there are three broad areas that we look at. Number one, how we generate revenue. That is called asset utilization. From that revenue, how much profit we can squeeze out. That is called margin. And then the question which every intelligent businessman will ask, if I put $1 in the business, how many percent returns can I earn? You know? Okay, so margins and returns are expressed as percentages. Asset utilization is normally expressed in terms of money. Yeah. Some of the ratios you will see later, I will express them as money. Some I'll express as percentage. Whether you express a ratio as percentage or money or a decimal is actually your personal preference, yeah. How you want to present it, yeah. But there are some good practice notes which I will share with you. So in the area of profitability, we are going to look at three different sections, and in your notebook you should write that profitability means, number one, ability to generate revenue. And what is that called? Asset utilization, yeah. That's called asset utilization, ability to generate revenue. Second one is ability to squeeze profit out of sales. That's called margin. Okay. And thirdly, ability to generate profits, healthy profits from the investment in assets.
Professor, sorry, can you repeat from one again, if you don't mind? Thank you.
Asset utilization, there are three things. Firstly, ability to generate revenue. That's asset utilization. Secondly, we are testing ability to squeeze profit out of sales, or to get profit out of sales. Squeeze might be like income tax squeeze you know. Yeah. To get profit out of sales. The third test is, of course, to achieve profitability based on investment in assets. Yeah, that's called return. That's why you see ROI, return on what? Return on investment. Investment in what? In a business. Return in investment means return on the assets. Yeah. So for purpose of financial analysis here, ROI is similar to ROA. Some of you, when you read stock market reports, you may find that they make a distinction between ROI and ROA. Don't worry about that, yeah, because that they are talking about it in their context. In our context, it's more or less the same. Okay, so you see, what happens here is this. For this company, in millions of Sri Lankan rupees, they generated 3 billion rupees. The previous year, 3.049, and this year, revenue went up. Yeah, went up. And compared to the total assets, also increased slightly from 2408 to 2432. But because the rate of generating revenue was a bit better, so when you look in terms of how many dollars per dollar invested in asset, doesn't matter whether the currency is rupee or ringgit or dollar, yeah, for every dollar invested in the business, this company generated $127 last year and 128 this year. That means their asset utilization is better, the way they use their asset to generate revenue. Some people even call it selling efficiency. Yeah, selling efficiency. The selling efficiency has improved. Now, you are not going to work out these numbers and then tell us, oh, you know, this is improved from 127 to 128. That is not a master's level analysis. If you tell me that and you put this thing there, then my response to that will be, I can see that. You should tell me why you think the asset utilization went up. So the magic word for you to do your task 1, ratio analysis, will always be why. What happened? How did it happen? Why did this ratio change the way it did? Now, talk about the business and use the ratios as evidence of what you are talking. Yep. Then the second section will be margin. Margin means, look, this is our revenue. For every dollar of revenue, how much profit can we earn? Yeah. So we have $1 of revenue. How much profit can we get out of it? Profit at which level? Sometimes profit people look at only net level, but my suggestion to you today is look at 2 levels. Look at operating level profit and look at the final net profit after tax, the profit for the year. So you also can compare whether there's a big drop between the operating profit level and the final net profit level. Yeah, like you see, this company, even though revenue went up, even though the selling efficiency went up, but the margins went down overall. In their supermarket business, they had to give special discounts on their cabbages and carrots and drinks and God knows what else. Yeah, and so actually their operating margin went down from 12.5 to 10.9%. So you will actually have to go and find out what is the story. Most of these stories you will find from the annual report itself. When you read the management discussion and analysis, which is one part of the report before the financials. You know, when you pick up a report, these financial statements that we are talking about will be halfway or after halfway of the report. Before that is all the story, the facts about the company, and from an MBA point of view, that is what you want because that is what is going to help you explain what is happening in the numbers. The numbers are the result of what the company did in business. Yeah, so you need to understand what the company did in business. You need to do that reading. Yeah, and although you are going to choose one company in a certain sector or industry and then choose another one to compare, I would humbly suggest to you that you try to find more than 2 companies in the same sector and read the starting part of it so that you really get a feel of what this industry is all about. And someone will talk about the challenges in the industry, someone will talk about the market prices of their commodities that this industry is affected by. So it's very interesting if you read it. Yeah, and it's after all business story, it's money story. I'm sure you will like it. Okay, so here you see.
Doctor, I have a question. Like when
Yeah,
we're
can we
picking
save the questions?
Okay, sure.
Now the new rule is save your questions.
Okay.
Okay. Let me finish the section, then I will come to you. Yeah. Okay, so the margins that we are talking about here now, you can see for this company, the margins from last year to this year came down. Yeah, you need to be able to find out the reason why. Now, because the margin at operating level is down, we also expect this to happen. Yeah, the margins at net level also came down. And I've put here notes for you. What is the meaning of profitability? What's the meaning of returns and margin? Yeah. Let's look at returns, the third element of profitability. If you talk to any intelligent investor, they will say to you, okay, if I invest this money, for every dollar I invest, how many percent return can I get? Yeah, and then they will compare that percentage return with what they are getting in the open market. So here you see, last year the percentage return in terms of operating profit was 15.8, and this year it has fallen to 13.9. So if you were looking at last year, you would say last year for every dollar invested in the business, they could give us 15.8% return at operating level and 11.4 at net level. However, this year this has declined to 13.9 at operating level and only 10% return, yeah, based on the profit for the year. Now, you need to be able to explain what happened here, why this happened. Yeah, so please remember, for profitability there are three things that you are testing. How much sales you make, revenue divided by total assets, that's the formula. Yeah, how much revenue you generated for every dollar of total assets, and then the second section is, from that revenue, how much profit were you able to get? Yeah, how much operating profit for every dollar of revenue, and how much profit for the year, net profit after tax, for every dollar of revenue. That's margin. Then returns, on the other hand, is simply profit compared to the total assets in the business. Yeah, profit for the year divided by total asset. That is profitability. Okay, question?
A question would be, how do we know that what is a good margin percentage?
You look
What
at
is
the
considered
industry.
as good?
You look at the industry. That's why I said read 5 annual reports. Yeah, it's based on industry and time. Yeah, of course now this year even making profits is good. Yeah, as long as you make profits, you're good.
The issue is, right, like these days, so many this year especially, though, so many companies ventured into gloves.
Hmm.
So, like, it's a construction company and it's venturing into gloves, so it sort of does
It
not
will
make
get-
sense.
It will saturate the market. That's all. But that's a different issue. Yeah.
I mean, when we're doing the comparison between the industries, right?
Yeah.
Within the industry for
Okay.
different companies.
Good point. Good point. You are only talking until 2019. COVID does not feature in your analysis.
Okay.
Yeah. So you are talking about the world as it was until 2019. I don't think you all have to worry about that. Okay. So
Doctor,
that's, yes.
sorry. Just now you mentioned we need to read at least a 5 years report. So let's say now we choose one public listed company, we go through the 5 years report. How about the competitor? It also needs to be the public listed company too. Then it might a lot.
Okay. I did not say 5 years. I said 5 different companies.
Oh, 5. 5 different.
Firstly, 5 different companies. Yeah. Number 1.
5 is
Number 2.
company, okay.
Yeah. And number 2, you already have the 5-year summary in a lot of these annual reports. Why I wanted to read 5 different companies is so that you understand the industry. But if you say you don't have time, you read 3 companies also can. Yeah. That's the idea. Okay.
Doctor, one
Okay, so
question.
Yes.
Is
Go
it,
ahead.
is it fair to assume that once the margin drops, the returns will correspond as well? Will always follow the trend, Or can there be a swap? Is there a possibility for a swap? That means the return is dropping, but the margin drop, but the return is higher.
I will show you later.
Okay.
Yeah, there's a formula for that. Yeah. Okay, so now we know profitability. I repeat this, please remember, talk in terms of three elements. Profitability means ability to generate income, ability to have strong margin, ability to provide strong returns. If you cover these three, you have talked about profitability well. First issue. Second issue is, can the company pay their bills on time? That's called liquidity. Yeah? The question you're answering is, can the company pay their bills on time? And that's the magic word, on time. You give people many years to pay, maybe they can pay, I don't know. Yeah, whether they can pay on time or not. Now, in practice, how will we pay bills? How does your company pay bills? If any one of you are working in the finance and accounting department, you know that you are always looking at your bank account. Why? Because your bank account goes up and down based on the cash that you already have, the cash buffer that you have, plus the cash that you're collecting from your customers and you're putting into your account, either one main operating account or a few operating accounts, usually a few. So we pay bills out of the cash we have in our pocket, so to speak, plus the cash we are going to collect from our customers. And that is why when we look at liquidity ratios, the Chartered Financial Analyst Institute recommends that you look at the cash ratio, how much cash the company has, plus how much they expect to collect. Now, logically, the cash that you have plus the cash that you are going to collect should be about dollar to dollar. Don't you think? Yeah, I owe $1 short term. Compare this to current liabilities. Bills means short term. Yeah, short term liabilities. So liquidity ratios measure ability to pay current liabilities, if you want technical terms. Yeah, this is the company's ability to pay current liabilities. That's what we are measuring now. Yeah. Now, how do we measure it? We look at cash and compare it to current liabilities. How much cash we have compared to current liabilities. As a very, very general and rough rule, yeah. Please don't take it as a fixed rule, but as a rough and general rule, business wisdom says that you should have 30 cents to the dollar for most trading companies, retail kind of business. You should have 30 cents to the dollar cash. That means if I owe short term $1, I'm not going to have to pay all my current liabilities in one go. Some I pay today, some I may pay next week, some I pay next month, some I pay in a few months time, because current liabilities means anything that I owe for the rest of the year. Yeah. So if I have about 30 cents to the dollar and I expect to collect 70 cents, it's part of the same equation. I have 30 cents in my pocket and I'm going to collect 70 cents during this year, so it's dollar for dollar matching. Then I can comfortably pay my current liabilities on time, and that is tested by a ratio called acid test. Yeah. So acid test is cash plus accounts receivable. Most finance textbooks they have the old-fashioned version of this ratio, where they say you look at your current assets, total current assets minus inventory, take away minus inventory. So if you take away inventory, what's left is usually cash and accounts receivable, isn't it? Yeah, so this is just simply a more direct way of presenting it. Actually, it's still the same. Yeah, so nothing new invented here. Now this company, last year they had nearly 40 cents to the dollar, and they have 50 cents to the dollar here. And because they're in the supermarket kind of business, their accounts receivable are not very high. Oh, I'm sorry, actually they are pretty high. Yeah, their accounts receivable are 103%, 124%. So when you look at the acid test ratio overall, you get a ratio like 142, 177. So here is where you need to use a little bit of, if I may use the word, a little bit of common sense and logic. Yeah, look, for every dollar of credit that these companies are taking, this company, current liability, for every $1 of their current liabilities, which is 432, they give credit to their customers 447 during that year. So that means they, for every dollar of credit they taken, they're given $1 of credit. But this is not their trade creditors, you know, this is the total amount that they owe. They have given $1 credit. Maybe that's what the business needs, and that's what you need to be able to explain. Yeah, how is the situation going? Is it improving or worsening? Here you find that this year they are giving for every $1 of current liabilities, their current liabilities came down from 432 to 359. Yeah, but their accounts receivable remained the same, 447. So effectively they are giving more than $1. Yeah, they are giving 124, if you like, of credit to their customers for every $1 of credit that they are enjoying. Yeah, whether it is good or bad, you have to look at the industry, you have to look at the time, you have to look at what the industry was going through during that time. Yeah. Now if I add up cash and accounts receivable, I find overall with cash and what they are supposed to collect is more than 1. Yeah, and the comforting factor here is they have a good cash buffer, so it is not likely that this company would have a problem paying their bills on time. However, if you are talking about collectibles, if you are talking about day sales outstanding, you might be a little concerned that the accounts receivable are a little high. So later, when we look at working capital cycle, we will go deeper into this. Yeah. So you cannot expect one analysis factor to tell you 20 stories. It doesn't happen that way. So far, what we know is, okay, the company has a reasonable balance of cash. They are quite generous in giving their credit to their customers, but overall, if we look at the asset test, they appear to have enough of liquid resources. Cash and accounts receivable is called liquid resources. They have enough of liquid assets to be able to settle current liabilities. Yeah, that's liquidity. Got money to pay or not, that's all. Then we have
Sorry, just now what is CCE? The abbreviation for the
Which one?
liquidity. This one, asset test ratio, CCE plus account receivable, AR. What is CCE?
CCE is cash and cash equivalent.
Cash and cash equivalent. Oh, okay.
Yeah, the one which is basically your cash reserves. Yeah, remember we saw this morning. Yeah. Okay, then we have working capital, the third area.
But
In
doctor,
working-
I'm sorry, we have to go back for a while.
Yeah,
If we add on the CCE and the AR, we don't get 636. How did we get the 636? Is it a figure which is readily available, or do we have to add the figure up?
let me do it for you. This is equal to 447 plus 189. It is 636 what?
Oh, okay, I'm sorry. Thank you.
Okay, now the issue of working capital. We had a good discussion on working capital today, and so we want to know whether the working capital is greater than 1, and if it is between 1.5 to 2.5, that's a kind of good ideal ratio for this company to have. This company seems to have like a textbook ratio, 2.1, very nice, perfect, and 2.7. So this is evidence. What does this current ratio indicate? That this company has sufficient amounts of long-term money to support their day-to-day activities. And this is also sometimes called a liquidity ratio. You know why? Because if you have enough buffer of long-term money, if for any reason there's some disruption in your operation, you can still continue paying. So this year people saw that companies that had the buffer, were they able to pay their staff salaries? Were they able to pay their key expenses? Were they able to pay their suppliers? Yeah. This is an important thing. Yeah, it's a survival thing. In the university where I'm working, the Malaysia University of Science and Technology, one of the financial management things that we did, although our university was set up by the government, MOF gave 100 million to set it up many years ago, but now we are pretty much a private university, yeah, but we work like a foundation. But that said, one of our financial management rules was that we want to build enough cash buffer so that we can pay our salary plus our operating expenses for a period of 12 months. We have a buffer of 12 months, yeah, for operating expenses and salary, assuming we get zero income. So over the years we have been building. First we build 1 month buffer, then 3 month buffer, then 6 month buffer, so on and so forth. Yeah, maybe I'm from a generation of Tun Tan Siew Sin lah. When Tun Tan Siew Sin used to run Sine Darby, they used to have very good and rich cash buffers. Yeah, and often people used to ask Tun Tan Siew Sin, why do you need such a big cash buffer? Shouldn't you be using this money to generate more profits? And then he used to give a very good answer. Business is not only to make profits today. Business is to make profit today, tomorrow, and in the sustainable future. Which means the only reason you keep cash buffer is not just because you have cash just because you want to make profit as much of it as possible today. No, you need to have cash so that you have sustainability. He didn't use the word sustainability then, but that's the catchphrase nowadays, yeah, sustainability. Okay, so this company's sustainability is reasonably good because their working capital ratio is positive. Then the other thing is the working capital cycle. Working capital cycle measures on average how long your money is tied down in inventories, on average how long your money is tied down with people based on the financial reports, and on average how long we take to pay our creditors. So you see, on average this company's money stuck in the business for about 50 days. Very consistent, 50-51 days, pretty consistent. That means if you are looking at a company and the numbers are pretty consistent, you know that their business as usual, yeah. But if there's a disruption here, then you have a story to tell. You must find out what happened here, yeah. How do you measure it? By right, you should measure it as average inventory divided by cost of sales. But now in published accounts, you often don't have average inventory. So what you do, you just take the year-end inventory. And will it be wrong? Yes, of course, you won't get the exact number of inventory period, but you will get the trend. And for our purpose, getting the trend is good enough. Yeah, if you see the trend is consistent, okay, fine, nothing to worry about. Same thing with accounts receivable. We take the year-end accounts receivable, all receivables in fact, and then we divide it by revenue. Yeah, and so these people, they have inventory of about just over 1.5 months. They have their accounts receivable for just over 3 months, isn't it? So, sorry, they had the accounts receivable for almost 2 months. Altogether, their gross asset conversion, their money is tied up in their stocks and debtors for just over 3 months, yeah, just over 90 days plus. So this 103 days. But the good news is, if their money is tied up in inventory and accounts receivable, they also get credit from their trade creditors, and we call that the accounts payable. How many days credit do they get? Well, they get 42 days credit. So the net effect is that they have to carry working capital for about 2 months. Now, we do this. These are also called efficiency ratios. Yeah, many British books of financial management call these efficiency ratios. Why? Because the shorter the working capital cycle, the better it is. I think someone mentioned this morning how fast the business turns over the assets. So this is what it is. Yeah, this is how you work out the working capital cycle. Okay, all good, huh? This is fairly straightforward stuff actually. And then we have debt management. In debt management, I am recommending to you to work out 3 ratios. Yeah? Gearing, asset financing, and interest cover. Now here I must give you a caveat again, because if you pick up 5 different books of financial management, there's a good chance that each one of those 5 books will have slightly different definitions of gearing. Yeah, we also have famous authors like Modigliani and Miller, and they are Nobel Prize winners, yeah, for economics, because they managed to conceptualize and give logic of borrowing to companies and things like that. And one of the theories that they said was that for listed companies' share price, it does not really matter how much of long-term borrowing the company has undertaken. And so then they worked out certain gearing ratios, and for them gearing was borrowing divided by borrowing plus equity. Okay, but usually for financial analysis we just do debt to equity. Now I have taken 2 versions of gearing. So liabilities, that means outside people's money. Yeah? Outside people's money, long term, that is total non-current liabilities, compared to the long-term money that shareholders put in. Matching, isn't it? That's why I chose this formula. Yeah, the total amount of long-term money that outsiders have put in, I compare with the total amount of money that shareholders have put in, and I call that my gearing percentage. So in the case of this company, the total amount of long-term money that outsiders have put in compared to the shareholders' equity is only 18%, 18.7%. So they are very conservative. Normally when this ratio is less than 100%, considered very conservative. Yeah, more than 200%, very aggressive. In between 100 and 200, we say balanced. Yeah, this is some of the terms we use. Balanced. Less than 100%, conservative. More than 200, aggressive. Okay, I want to ask you now, do you think it is better for a business to have a conservative gearing ratio or an aggressive gearing ratio?
Conservative.
Depends.
Depends. The answer here is it depends, isn't it? Yeah, it depends.
Nature of the industry.
Nature of industry, the economic outlook. Yeah, now might be time to borrow just to survive. Yeah, normally they say when companies first start up, there are 3 phases to company startup. So in case some of you are business owners or thinking of becoming business owners, think about this. Your first phase should be, you should have enough money to survive. Yeah, the first year, the first 2 years, depending on what you're going to do. Yeah, so the first phase should be survival. Then after you think you are more or less stable, then of course the main reason why you went into business, profit. Not everybody is lucky that straight away you go in, you get profit. So phase 1, survival. Phase 2, profit. Phase 3, growth. So looks like many industries now, many companies now may actually have to go back to the drawing board and go through the survival for this year and the next, we don't know how long, and then return to profitability and return to growth. Yeah. But those of us who had good cash buffers, who could survive, and who fortunately our industry is not so badly hit. Well, actually it is, but fortunately for us, we were already doing online classes last year, so we already had all the technology in place. Yeah. Only thing now, instead of doing it from my office, I'm doing it from one of my rooms in the home. Yeah, that's all. Okay. So gearing, how much of other people's money long term in our business compared to what we have put in. This company is very conservative. Another way of answering the same issue is the same issue. Yeah. Or another angle, another lens to look at it is the asset financing percentage. If I look at my total assets, how much of my total assets are supported by borrowing? So if I look at total borrowing, in the case of this company, they're pretty conservative, so you might expect this to be low too. Yeah, 5.1% the previous year and only 1.5% this year. Yeah, so that means most of the assets are financed not through borrowing, maybe through current liabilities, other current liabilities, but not on interest bearing borrowing, because borrowing means you pay interest. Yeah, that's why we add up the short term and the long term borrowing. For this ratio, please note, total borrowing here means short term plus long term. Please make a note to yourself. Short term plus long term, total borrowing. So actually then, how much should a company borrow? That's the question we want to answer. Yeah? How much should a company borrow? Well, if you ask a banker, they will tell you as long as you have repayment capacity. I think somebody's mic is on here.
Your mic.
Okay, thank you. If you ask a banker, then they will tell you as long as there is repayment capacity, we are happy to lend you money. You should have repayment capacity. Yeah, if you can repay, that is good. Now, what does repayment capacity depend on? Repayment capacity for a business depends mainly on your ability to generate operating profit. Yeah, profit from operations. And the way we measure this is interest cover. So what we say is, finance 2N. Let me get rid of 1N. Yeah. What we say here is this: if the company pays $1 interest to the banks, they must be making at least $10 operating profit. Okay, I repeat this. If a business is paying $1 interest on loans, they must be making at least $10 operating profit. Otherwise, they have borrowed too much for their own good. Yeah, that's why I put here should be at least 10 times. Okay, so when I was in corporate banking, my job was to go and sell loans basically to big companies and corporations. I will look at the companies where the interest cover is more than 30 times. Because I was in charge of multinationals, the Japanese desk, steel and electronics. These were my focus areas as a loan officer. And the way our bosses had organized us was that they gave each credit manager a portfolio. So my portfolio for me and my team was this. And we always used to look for companies where their interest cover is 30 and more. If it's 30 and more from their annual report, we will do a background check. Who is this? Who are the people behind this company? what kind of business they are doing. Have they talked a little bit about their business plans? We used to look at the employment pages to see who is hiring. Why are they hiring? Are they expanding? Are they buying new machine, new equipment? Marketing boys and girls, please take note. This is where we used to get the information from. Then we will go and meet them, and then I would say we are here this morning to discuss a banking relationship with you. For the good companies, the banker will come to you.
Doctor,
Yeah.
does it applies when we're talking funding from VC, for instance?
No, VC is different. I'm talking banking, my friend.
Okay.
Yeah. So when we are in corporate banking, we try to identify companies which have a strong interest cover. Yeah, strong interest cover, and strong interest cover means more than 10 times lah. Yeah. Okay, there you go. This company, actually, I just put in some number here. Assume. I put here assume. You know why? Because at this company, actually, this case study, they did not actually have a net interest payment. Look, their finance cost was just 7.9 billion rupees, but their finance income was 18.49. Because they are cash rich, what? Supermarket, cash rich. They are earning more interest from the bankers than what they are paying. So actually, if you see a situation like this, I purposely left this behind there. It means that this company has no interest rate exposure. If the interest that you pay on your loans is lesser than the interest that you earn on your fixed deposits and other deposits, then you have no interest exposure. So whenever you measure this interest exposure, you must always net off what you earn back from the banks. And most listed companies do that. Yeah, they give a lot of interest to banks on loans, but they also earn back a lot of interest. So we always compare the net interest cost. That's why I call this the net finance cost. Should be 10 times or more. That's it. That's the rule. And finally, we have the investor ratios. Are the shareholders happy or not? Now, earlier someone asked me a question, what should be a fair profitability ratio? Fair profitability ratio difficult to say. Depends on industry, depends on time, depends on opportunity, depends on specific projects, depends on your social and networking connections, so many things. Yeah, depends on that. But from a financial management point of view, what about the shareholders? How much should be the return on equity? So this is the money that the shareholders put in, the equity, and this is the profit attributable to them, profit for the year. Because that's the profit that they can touch. They cannot touch operating profit. So don't try to do an operating ROE. It doesn't really make sense to me. Yeah. For every $1 that the shareholders put into the business, this is the profit attributable to them, the profit for the year. That's why it's called profit for the year. Last time we used to call it profit for the year attributable to shareholders. Now we dropped off that very big terminology, yeah, but that's what we still mean, yeah, profit for the year. So here you see last year was 16.5, this year is 14. If this was a Malaysian company, then I would ask myself, what is the unit trust returns, average returns for a balanced equity fund? Is it about 7 or 8%?
Yes, about that.
7 or 8%. So people ask me, what should the ROE be? I say double that, double that. Yeah. If I put money in a unit trust, I can earn 8%. Then when I do direct investment, my risk is more direct to you. You must at least compensate me double what? Yeah. So if I can get 8% from a unit trust, I would expect at least 15-16% ROE from an investment. Yeah. But life is not always perfect, so sometimes you get more, very much more, sometimes you get very much less. Yeah. The next ratio is of course dividend payout. Now These two ratios are actually even non-listed companies can work out, because return on equity, how much money the company makes for every dollar that the shareholders have put into the business. We compare and we get the ROE. Second question that shareholders are interested in is, okay, from the money that they have, the profit for the year, how much they pay out as dividend. Yeah. So this company has a good high payout dividend rate. Why? Because this is a multinational company. You look at Dutch Lady, Carlsberg, all the multinational companies, whatever, yeah, their payout rates will be very high. DG payout rate will be very high. If you are an investor that likes high dividend income, then you go for a multinational, because multinational corporations don't like to leave their money back in the subsidiaries. They try to take out as much as possible. In Malaysia, we actually have dividend payment policing laws. We do. Yeah, that means we say to these multinationals, hey, you cannot take out too much money from the company. But we don't enforce them very strictly, because we are still a growing economy. We still need their money. Yeah, we still need our foreign direct investment. So, but you can be sure, if God willing we come out of COVID good and healthy, God willing we get good leadership in the country, political leadership, and in 10 years time the country is doing very well, and we are very strong and stable, and we are becoming very close to being a fully developed nation, then this kind of things will start happening. We will start policing how much of our money, Malaysian money, is flowing out because of dividend payments and things like that. Right now we can't afford to do that. It's not that we don't know. I can assure you there are a lot of clever people in Bank Negara, in EPU and everything. Many clever people there. Really intelligent people. Yeah, it's just that we know the timing is not right yet. Yeah, that's all. So two things here: how much the company made for every dollar that I put into the business as a shareholder. That is called return on equity. Yeah, the first one was return on assets, total assets. This one is just my investment in the business. Secondly, from the profit that they have made for the year, how many percent they pay out as dividend. Now the third thing, the third ratio here is a ratio that applies to listed companies only. Why? Because it needs you to have data for share price, and you know non-listed companies don't have this data. Yeah, but here we have the data. So you see, this is earnings per share. You remember, earnings per share is simply net profit for the year per share. Why do I want to express it on a per share basis? So that I can compare it with share price. That's all. This company's share price is 130 divided by 9.55. We get the PE ratio multiple 13.6. Now PE ratios from a financial analysis perspective are generally a measure of general market confidence. So if the PE ratio of the company over the years is stable or it is improving, then you know the market respects the company. Yeah? The market confidence in that company is very good. Some years ago, IOI made an investment. IOI made an investment in Indonesia. They lost some money there, and so their share price went down for about a week. But after that, started going up. In fact, I was tracking that share at that time. At the end of it all, their PE ratio actually went up, not down. Their PE ratio went up, which means the market says, even though you lost a bit of money last year, we still think that you're a great company. Yeah, we still think this is a strong company. So
that's a very
Premalata, your mic. Yeah. So the PE ratio is a measure of market confidence. Please do not use things like what you see in sometimes books. Oh my God, I tell you, sometimes authors of books have really misled the whole world. You know, they talk about number of years that you have to wait to recover your investment. Mathematically correct, but nobody is looking at number of years to recover my investment. Nobody is looking at that. So in the market, the PE ratio is an indicator of market confidence. That's all, no more and no less. Yeah, so these are the ratios. I think there are about 17 ratios here that I've gone through with you. These 17 ratios are the core ratios that you must know. Probably in the tutorial, Mr. Francis might work with you on other ratios as well. Yeah, but these are the main ratios that you need, and the main information that you need to pick up from the financial statements. I think most of you would realize by now, you don't need to read every line of the financial statement. You just pick up key points, yeah, key performance points, put them into the ratios, and Bob's your uncle, you will get a fairly good picture of the financial performance of the company. Okay, Q&A time.
Doctor, I have one question. Can you scroll up the gearing percentage?
Okay.
So how about royalties, right? So if the company has to pay royalties to someone who have, let's say, lend them some cash, would that fall under total non-current liabilities as well?
If it is long term, yes. If it is a long term liability to pay people, yes. Anything that is long term liability. Yeah.
Got it. Thank you.
Okay.
Doctor, in last time you explained the sustainability for having the buffer cash or the and receivable. Yes. So what is the deciding factor? I mean, how a company will decide that, okay, like you gave your example that you will have 12 months salaries and operating expenses in terms of cash. And I mean, how long, will it be 2 years, 3 years? I mean, how would you know that? The deciding factor, up to what level?
Okay, your question is a very good question. But you see, this is something like buying insurance. How much insurance do you want to buy? Some people are more risk averse. They will build up a more healthy cash buffer. Some people who like to live a bit more aggressively, they will live with thinner cash buffers. But as a general guide, ask yourself, what is the total amount of short-term amount owing? Let us say, for every $100 that we owe short-term current liabilities, we must have at least $30 cash in hand. That is what good treasury management practice is. Yeah, 30% cash for every dollar that we owe short-term. Yeah, cash buffer. But that's a general guide. Different industries will have different requirements.
Another thing that you mentioned is for the interest cover. So you said that you mentioned that, I mean, if the interest cover is high, you look at the clients or the customers that who are having that the high interest cover. So if the is having the high interest cover, then why they come for the loaning? Other than what I understand, I mean, they are growing and they are trying to find some way. But otherwise, I have seen that the companies, they always come out for the loan if they are in the financial difficulties.
Correct. And we don't want to lend money to them.
Exactly. I mean,
we want to lend money to people who don't need it.
Exactly.
So people,
yes, please.
Yeah. So what I'm saying is, that's why I go for companies in corporate banking. I look for companies with interest cover with 20 times, 30 times, 65 times. The world average of good companies in the world is about 65 times interest cover, by the way. Yeah. And of course, it changes over time a little bit by 60-65 times. Now, companies that have 30-35 times interest cover, they don't really need to borrow money. So that is why I have to go and convince them, hey, give me some business, lending business. So, and this is the way the world of business works, because they know that it is always good to be friendly with more than one banker. They may give me a chance. Yeah, and so I was able to actually lend, because sometimes they just wanted to give me a chance. Most of the time they didn't need the money. I went to talk to a German multinational company once, and so the financial controller was talking to us, me and my colleague, um, and our bank was very smart. They paired me up with Ani Ong. Ani Ong is an economics graduate. She is a hot-looking Malaysian chick, I can assure you. But you will think she's very demure and very simple, but she's the fierce one. When it came to collection, she was in front. I will hide behind her. Yeah. Now, so this is all marketing strategy lah. Anyway, so we both used to go for this marketing, and we went and visited this German company, German multinational, I remember. And so first that guy said, "Oh, okay, there's a US dollar inflow into your KL money market. Well, what's happening? Can you tell me?" So we had to explain to them, okay, what are the market conditions? Why is there a money flow happening? So how long will this money be here? Is this hot money? And then I said, yes, this is hot money. If this happens, if the Fed say this, then this money will go out. If Hong Kong does this, then this money will go out. So for the first 15-20 minutes, we were just talking about the financial markets, which means this finance manager is actually giving me an examination. They are testing me whether dealing with us is worth their time or not. And then they said, okay, fine, can I have a look at the annual report of your financial institution? And as standard practice, when we do corporate banking, we always have an annual report with us. So we gave our annual report. He reviewed it. He looked at our 5-year chart. He said, you lost some money in your retail banking. He said, yes, sir. This is why we now want to focus on good assets, strong assets like yourself. He laughed. Yeah. Can you imagine the scenario? I'm a banker. I want to lend you money. And you say to me, show me your balance sheet first. Show me your accounts first. Yeah, other way around. Yes. Yeah. So it's a different ball. Yeah.
And he is the deciding fact. I mean, they are the people who decide that what level of loan they will be taken, and they will take, and how much is the interest they will going to pay. That it is totally the opposite way, other way around when it works.
Yes. Sometimes it's just the opposite way. Exactly. You're right, sir. Okay.
Thank you.
Welcome. All right. I think you all want to take a 5-minute break, right? Let's take a 5 minutes break. Then what I've done is, you see, I have created a new tab, and I'll share this at the end of the day with you. I have put in the statement of profit and loss here, and an empty worksheet here. Yeah. Now, if it is not too much trouble, please download the 2019 annual report of KLK, Kuala Lumpur Kapong. Yeah. And then that will be very useful for you to follow the discussion. And I will show you what are the numbers that you need to pick up and put here, and I will be asking for your input from time to time. Yeah. So let's take a short break, 5 minutes, then we'll get back to this.
Thank you.
Thank you.
Thanks, doctor.
Yeah.
Thanks, doctor.
Thank you. Okay, guys, welcome back. Let us look at how we can work through this case study. Okay, and this is of course KLK. Now, I'm going to share this template with you so that I don't want you to waste your life working out or calculating ratios on the calculator. But for today, I would recommend that you practice on your calculator for the sake of understanding. Yeah. Otherwise, you can use this template.
You will share this later in the student portal, right?
Yes. Yes.
Okay. Thank you. Sorry. Thanks.
And so you could use this to work out the ratios for the companies that you are talking about, so that you have enough time to go and read the annual report, read the news reports from Google, go to the investment websites and do a little bit of research, because I think that is the whole idea of a master's level study. Yeah. And then you come with a good considered comparison. You compare the two companies on the basis of profitability, liquidity, working capital efficiency, debt management, returns to shareholders, and whatever other areas. Later we will go through the task tomorrow, and I will give you some guideline on that. Yeah. Okay, so let us see. I want to now work out in millions. It's perfectly fine for me to round up to millions. The years that I want to look at are 2019, 2018. I should have created some space for that, isn't it? Let me see if I can still do that. Insert. Yes, it happened. Good. So I can say that this is analysis of KLK Berhad, and for the year 2019-2018. A lot to read and a lot to do, like someone observed just now. I'm sorry, but well, you're going to be masters of business administration. Yeah, think about that, masters. Yeah, that's a great thing, you know. Okay, in profitability, we have three things to measure. How efficient is the revenue generation based on the investment in total assets? For every dollar in the assets, how much revenue is generated? How much profit we get out of our sales? So profit, operating profit over revenue, profit for the year over revenue. Yeah, we are going to compare that, and then returns, which is profit compared to the investment. Let's see. So first of all, revenue, here we go. Let's pick it up. Last year, 18,384, if I round it up, right? 18,384. And this year, 15,534. Total assets come from the balance sheet or statement of financial position. So you see my template, the moment I put in revenue, wherever there is revenue, it copies it automatically. Yeah, because I already put in the formulae for you. Yeah, so let us go and fill up the statement of financial position first. I thought one we will leave it live, and one we will pick up the information, only that information that we need. So this is the data that we need from the statements of financial position, yeah, for 2019 and 2018. And let's do this and this. These are the statements. Oops, I don't think you can see this. Yeah, wait, let me stop share first. Share screen. If I share my screen itself, share, can you see the statements of financial position now?
Yes, doctor.
Yes.
Okay, now
yes, can see.
I'm going to do
Yes, yeah,
something. Wait, now you tell me again. Here, can you see this now?
Yes. Yes, sir.
And oh, beautiful. Life is beautiful. Because sometimes these systems work and sometimes they don't. Okay, I have to do this manually. Okay, no worries. This is a statement of financial position, and in my Excel worksheet, let me just close this first. In my Excel worksheet, I need a value of total assets.
399.
Yeah, total assets, current assets, non-current assets, and then I will get some details of current assets. I will need to pick up some numbers for liabilities and then some other data. Yeah. So yes, please help me out here. Can you tell me in millions from this information here, how much are the total non-current assets? 12,266. 12,266 and
8134.
12,854, is it?
Yes.
Previous year?
Yeah, 12,854.
Yeah. And then the current assets?
8134.
8134.
Thank you, 8134. That's the current year. And previous year?
5991.
5991. Beautiful. Okay, let's look at the inventories now. Yeah, all the inventories. So in this case, my inventories, I will take the inventories plus from our perspective, if you have put something under current assets, biological assets, I would suggest take everything. Yeah, so you take all these numbers for both years. So in this case, we would get our inventories to be equal to 2124 plus 98. You see how we do it? I'm making an assumption on the data based on what I want to do. I want to be conservative a bit. So I want to take the total amount of money that is tied down in inventories. If you tell me, no, they said inventories is only the first number, okay, fine. That's also correct. Yeah. And then we have this one, 2285 plus 101. Yeah. And we got inventories as whatever. Yeah. Let's look at accounts receivable. Is more interesting. Accounts receivable is trade receivable, other receivable, amount owing, contract asset, tax recoverable, everything. Yeah, all these are receivable. One way or the other, it represents our money tied in with other people's pockets. So until tax recoverable, I'll take all of these things here. Yeah, and that's how you pick up the data. Yeah. So now for accounts receivable, I will have to add up 1225 plus 827. Everybody with me on this? Huh?
Yeah. 14.
Okay.
Yeah.
Yeah. Good.
Yes, sir. So far, so good.
2176.
33967.
Yeah. So here, if I add this up, 1365 plus 588, is it?
Yes.
Plus 49,
60.
60. Q.
60.
Plus 60.
So 2062 lah, yeah. Then the balance of the items. Again, you have two choices. You can take the cash and cash equivalents from the cash flow statement, or you can just add up all these items, including what they called cash and cash equivalent. Some people say, no, you are being too generous. Just take only cash and cash equivalent, which is not wrong. So let us today just take this. Forget about the short-term funds and all that. Yeah. So we just take 2041, 2041, 2041 and here
1277.
1278.
okay, 1278, yeah, 1278, yeah. So I'm taking a very strict view for this company, yeah. Let's look at their liability, their funding, their short-term finance from their current liabilities. Total current liabilities 2869 and 2738. You're right, 2738. And non-current 6243. Sorry, this side.
4063.
And 406. Thank you. 406. Okay, and there you get total liabilities. How much is the shareholders' money in the business? That's the total equity. That's 11287, I believe. 11287 this year and previous year.
12046.
Perfect. 12046. Good on you. Well done. Yeah. Now, if you want to do a quick check here, we know total assets are equal to total liabilities plus total equity, isn't it? So if I do total assets here minus total liability minus total equity, what will I get? If I've done the correct numbers, total asset minus liabilities minus equity, I should get 0. Yeah. So I get 1. 1 is rounding off error. It's okay. No, nothing serious. Here I get -2. Okay, fine. If you get 1 or 2, you know, because you're rounding up to millions, that is fine. But if suddenly you get 35, 48 or something like that, then you have to go back and check and see, yeah? Okay. Let's look at total borrowings. So here I'm going to look at long-term and short-term borrowings, both. My borrowings, note number 34. This is 5169 here. And then I need this number 134. So what I'm going to do is I'm going to cut this out. So my first number and the last number I'm going to add up. Yeah, put it here. So my total borrowing will be equal to, and this is how I propose you do your work exactly. So this should be 5170, I think. Yeah. Plus the last number 1349.
1349.
1349. 6519.
Yes, thank you. And this side will be 306
plus 1221.
plus
1221.
Yeah.
4283.
Yes, excellent. Okay, then we have this data, earnings per share. Earnings per share is given at the bottom of this statement of profit or loss. Remember, there you go, earnings per share, 58 cent and 57.2 cent. I suggest to you, for most of the time, it will be easier for you to convert this to ringgit. You know why? Because your share price is ringgit. So you can compare RM to RM. Yeah. So here I would say this is 0.58 and the previous year is 0.572. Yeah. I've already adjusted the cells to accommodate this. Now the task for you is this is year end when 30th September. Yeah. Can you please look up on the internet the share price of KLK on 30th September 2019 and 30th September 2018, because we want to take the share price at the balance sheet date itself. Yeah, that is one comparison. Can you take
repeat the dates?
EPS? Yeah.
Can you please repeat the dates? For which dates?
30th September 2019 and 30th September 2018 for the last 2 dates here. So please talk to Auntie Google and give me the share price.
2019 was 21.22.
2120 is it?
21.22.
21.2 huh?
Yes.
Yep.
Okay, previous year?
24.96.
24.96. Perfect. Thank you very much. Okay, now I have got all the key data points that I need for my balance sheet, and I will pick up key data points from my statement of profit or loss, and that's all the data I need, and I can actually now complete my ratio analysis. Yeah. So now for total assets, I could do this. This is equal to, and all the way here, total assets here, this one. Yeah. And for operating profit, well, this one I can also Control C is copy, and you move this cursor this side, enter, there you go, and straight away you can see this is not LKR anymore, this should be RM. Last year, for every dollar in the business they generated 98 cents. This year only 76 cents. So don't worry about whether it's good news or bad news. For you as an MBA candidate doing an assignment, it's always good news. You know why? Because if there's a change, then there's a story to tell. If it is the same, then it's a bit difficult. You don't want it to be same. You want it to be either good news or bad news, so that you can go and read the annual report, read Google, read the press, and get a story, and that will enrich your assignment. Why? Because this is the evidence that you need to give to your examiners, that look, I know how to read annual report, I know how to work out the key ratios, and I know how to interpret those ratios in terms of what's happening in the business. I can read these numbers, and I can do the right kind of investigation to find the answers of what's happening. So ratios are not always going to give you the answer. Ratios are going to guide you in the correct way for you to go and find the information. So here we need to find the information. What happened this year? Was it commodity prices went down? What happened? Yeah, we need to know. Okay, operating profit. Here we go. This is operating profit. Current year 981. So let me just put that 981, because I'm working in millions, isn't it? Yeah. And previous year was 1167. Okay. And net profit for the year, 651 and 660. And I have completed my section on profitability, yeah, because the template will pick up your operating profit automatically and put it down. So you see here, margin is more or less maintained. Net margin has actually improved a little bit. So the net effect of that is that operating returns have gone down significantly, but net returns are still pretty much maintained. Earlier someone asked me a question, if margin goes down, does it always mean that returns also go down? Well, let me explain to you like that. Yeah. This is called the DuPont system. DuPont system of ratio analysis. In the DuPont system of ratio analysis, it is basically an analysis of ROE, return on equity. Yeah, return on equity, according to their definition, is the equity multiplier multiplied by return on assets. So what is equity multiplier? ROE is equal to total assets divided by equity multiplied by ROA. Yeah, this will still give you the same answer if you took net profit after tax divided by equity. Yeah, what is ROA? ROA is net profit after tax divided by total assets. Now please look at this term carefully. In the first term, total asset is the numerator on top. In the second term, it is below. If I multiply these two, it will get cancelled out, isn't it? Then ROE will become what? It will become equity divided by net profit after tax, which is what we studied earlier. Yeah, sorry, equals equity divided by net profit after tax. Yeah, and that will give you ROE. Some basic mathematics here. But now, yep.
I think it's the other way around.
Yes, sometimes when I say equity over NPAT, you are very good, you caught it. Yeah, it means NPAT divided by equity. Yeah, happens.
No worries.
Thank you. Thank you. Okay, now you see, therefore we have a relationship between ROE and ROA. Yeah, now if I wanted to then analyze ROA further, ROA I know is a net profit after tax divided by total assets, isn't it? Yeah, but I can also tell you this, that this depends on profit margin and it depends on asset utilization. I'll give you the mathematics first, then I'll give you the logic. Yeah, what is profit margin? Please tell me. On net profit, it will be net profit after tax divided by revenue, isn't it? That's profit margin. Yeah, profit divided by sales. There you go, profit for the year divided by revenue. Asset utilization is total assets divided by net profit after tax. Revenue, sorry. Revenue and divided by total assets. Sometimes you try to rush and you make mistakes. Okay, now think about this. If I multiply these two numbers, yeah, if I multiply profit margin multiplied by, yeah, if I have this here multiplied by by asset utilization, yeah, what will happen is revenue and revenue gets cancelled off. When revenue and revenue gets cancelled off, you get back net profit after tax divided by total asset. Okay, so that means the return on assets, ROA, is explained by changes in profit margin and asset utilization. That's the maths. Now think about the logic. If a business makes a higher rate of profits in any one year, if they make higher returns in any one year, they have made higher returns either because they were selling more efficiently, that's asset utilization, or they were selling at better profit margin. That's it. There are only two reasons why you make more money. You make more money when you sell at better margin, cost go down, your price go up, whatever the reason, as long as margin is better. You make more money when your profit margin is better and or when you sell more efficiently. You can generate more sales for the assets that you have in your business. Yeah, and if your profit goes down, it goes down because your margins went down or because your rate of sales went down. So you see, this is the relationship, if you like. The profit margin and asset utilization explain changes in return on assets. So when you do your analysis, you can either start from sales or you can start from ROA. Yeah, and then you can say, see, the return on assets has gone down. It has gone down because margin went down, and margin went down because of competition, and sales actually went up, but it was not enough to compensate for the fall of margin, something like that. Yeah, and that will be your story. Okay, so that covers that, I hope. There you go, profitability done. Let's now fill up our liquidity ratios with the data from this company. And we already have got our cash and cash equivalents here, haven't we? Look, where is our cash and cash equivalent?
041.
Yes, thank you. 2041.
Yeah.
And current liabilities are
Current
269. Yeah, there you go. And this is for 2019.
Yeah.
2019, and then I need for 2018 as well. And I can actually just copy. That's the beauty of Excel. Yeah? You can cash and cash equivalent 1278 and 2738. Yeah. So cash ratio. This company also chat liao, a lot of cash. Yeah? Last year 46%, this year 71%. Yeah, the accounts receivable ratio small. So overall, what is the story? Let's see. If I have cash and cash equivalent plus my accounts receivable, cash that we have already, plus what we are hoping to collect in the coming months, is it enough to pay our current liabilities? Well, it is 86.7, not dollar to dollar matching. But are we worried? No. Why? Because the cash buffer is very strong. Yeah. Now, why is it that many big companies, when you work out their asset test ratio, it won't reach to 1? In fact, many financial experts say it will usually be between 70 cents to 1, not even 1. It doesn't have to reach 1. Why? Because your current liabilities are not all due in one go. Some you pay today, some next week, so on and so forth. So you don't really need to have a 100% dollar to dollar match. Yeah. Okay. The important thing here is actually cash. At the end of the day, if your cash is good, your liquidity is good. Simple. Yeah. What the accounts receivable are, how you're going to collect, that's a different story for another day. But bottom line, if you have got good cash reserves, you're sitting on good cash buffers, this company is sitting on 2 billion of cash, no problem. Yeah. You see, the airline industry got whacked left, right and center, isn't it? Yeah. And one of the companies that is affected very badly is, of course, Air Asia. I guess many of you had holiday plans that you had to cancel. But Air Asia is still strategizing. They are trying to create small pockets of revenue from their food business. Yeah, I think they have one in Mid Valley, one outlet for this Pak Nasi, Nasi Lemak and stuff like that.
They even having more people right now.
Oh, really?
Yes, AirAsia.com.
Yeah, Sandan. They are giving special offers on all the inventory they had on the things that they used to sell on the aircraft. Now is a good time, to buy the stuff. Last time I bought a Maserati watch. It was 900 something, nearly 1000. Now I think you can get it cheaper. Yeah, good things to look out for, perfumes and all that. You might get a good value for it. So they are turning that cash in. That's one thing they did. Now then they went and talked to the companies who have leased the aircraft to them, and then they cancelled some orders. Of course, all of that things they will do. Then they talk to their airports where their aircraft are based, and for most airports, I'm told they have already renegotiated a rental, which is a very common sense thing to do. One of the companies that I'm involved in, we knew that this is a big hit, so I went and told the landlord, look, I give you 3 months notice lah, because my tenancy agreement allows me to give you 3 months notice. Why? Well, friend, times are bad. And he looked and he said, yeah, I can't blame you also. Times are bad. I have to find somebody else. Yeah, I said yes, because I cannot sustain at this price. Then he said, how much do you want your rental to be? I said 1/3 what we were paying before, 1/3. He said, come on, you have to be ridiculous, 1/3. 1/3 back end. We were paying 16,000 for the place. So I said 1/3. He said, no lah, not reasonable lah, not 1/3. I said, yeah, I agree. In your area, for you to give me 1/3, very difficult. But I just move out of this area and go to another area nearby, I can get 1/3. Yeah, so for me it doesn't make sense to stay with you anymore. I want to move out. Why? Because I'm in survival mode. Maybe your location was a bit more optimum for me. The place I'm moving to, not so optimum, but it's okay because it's survival mode. I'm not going to get tons of business straight away. So for the next 2 years, I locked in there at 1/3 rental. Immediately, I've saved a big cost. Yeah. And then in terms of staff, many companies have said already, okay, the next 3 months, we will reduce your salary by so much, then so much, then so much. Yeah. What I understand is from Air Asia, most of their pilots you need to hang on to, because when really the business, the pent up demand goes, many people are saying, oh, people just waiting to get out. I am one of them. Trust me. Yeah, I'm going to take 1 month leave and fly to 20 different places if I can. Yeah. I'm also a bit of that group that says that this is just a bad flu. Yeah. And if your constitution is well, you might fall ill, but you won't die. In percentage terms, less people have died from this disease than from many others. But let's not get into that argument. Yeah. But point is that there are people like me, pent up demand, ready to go. So airlines are trying to conserve their pilots. In China already, their local tourism is booming more than before, because people cannot go out. They are actually, local tourism has gone up, and they're looking for pilots. Yeah. So these are the things that you need to look at when you are trying to measure liquidity. There are so many circumstances that you need to look at. You need to look at the business circumstances, you need to look at the nature of the business, and you need to look at the business outlook. Those companies that had good strong buffers, they can survive a bit longer. Companies who are living day to day are okay. They become case studies for business failure. All is not lost. Yeah, we still get some benefit out of them. Yeah, there you go. Okay, let's look at working capital and efficiency ratios. We already got the current liabilities. Let me key in the current assets now. So if I pick up the value of current assets, here we go.
Sorry, doctor.
Yeah.
The AR ratio figure is wrong, I think.
They are wrong. AR, current accounts receivable, 447, no? Oh, minta maaf Yeah, I've taken something else. AR is this one, 2177. Very good. Thank you. Thank you very much. Yeah, I straight away jumped to acid test already. Yeah. Okay, now then the acid test is more than $1, which is very rich. But you might be a little concerned, yeah, that their AR ratio is high. But again, look, I said this should be 30-70. This is 70-70. No complaints, sir. No complaints. Yeah, very conservative company. But if you look at other plantation companies, look at FGV, you may not find ratios that are that rich. It's a different kind of story there. Okay, working capital. Thanks for that. Yeah, thanks for that. Just now 8134, and current assets here. Current assets, where are the current assets? Here you go. 5991. Yeah. And again, the current ratio you can measure in terms of money. That's what it is. Or you can measure as percentage, or sometimes people like to say 2:1. Yeah. Let me put this to 2 decimal places. 284 and 219. There you go. Yeah, current ratio. Good and healthy. Why good and healthy? Because it is evidence that they have enough buffer of long-term money to use for their day-to-day operations. Yeah. So let's look at working capital cycle for trading companies, manufacturing, agricultural companies. Definitely this is important. Yeah. So what is this formula that I put in? Oh, I did the 365 here. Clever. So I'll just put in average inventory here. Average inventory here, and cost of sales. I have to go back here now to find cost of sales. What's cost of sales? 13,858. See, you may have to sometimes work out a ratio, one number from one place, another number from another place. Yeah, get used to this, because what are you doing? You are comparing how revenues change compared to investment, how cash flows change with regard to business activity. So the information is in different statements. Different statements have got different purpose. So obviously you will need to do a bit of a walkabout. Yeah. So this is 13,858, which I will key in. 13,858. 13,858. The one which I have here, the ratios template, you just key in the top part and then everything will get added up. Yeah, you won't even have to worry too much about that. Okay, so here definitely average inventory I can copy over the other side. What was this the last year? Cost of sales, how much was it?
16,212.
16,212.
212. Yeah.
16,212. 16,212. There you go. About almost 2 months. Inventory period almost 2 months. Yeah, gone up a little from nearly 54 days to 59 days. 54, about 5 days. Gone up by about 5 days. Not alarming, but not very healthy also. Wrong direction. Yeah. Then accounts receivable. Let's take our total accounts receivable. Here we go. All the accounts receivable. 2177. Revenue we can just pick up from here, isn't it? We used revenue just now. Yeah. And so I can do the same thing for the next year. Last year, Control C to copy, enter to paste it. Yeah, and I get my gross asset conversion about 3 months last year, a bit more this year. Yeah, AR period also has gone up a little bit, but we get credit from people, isn't it? Yeah, let's see what is the accounts payable. Did we take the accounts payable in here? Oh, I missed it out. Okay, no worry. So now I have to take separately another number. Let me just create the format, Control C. I'll plug it in, accounts receivable. And we'll check it on the balance sheet. Accounts receivable.
Payable.
Should be account payable, right?
Payable, sorry, payable, thank you. Trade payable there. You can take trade and other payables, yeah? All of this. Trade and other payables. So these two items are your payables. Okay, just like we did for AR earlier. Let me just mark it here. Account payable, sorry.
Tax payable not included, is it?
You can, if you want. Was tax payable there just now?
Yes.
Yes.
Current liabilities, trade payables. Oh, tax payable.
4089.
Okay, why not? Sorry, cut it nicely. Okay. So we have now the payables are 518 plus 842 plus 41, yeah? Tax payable. Previous year is 555, 35. Last time we used to have the 35 book. 789.
787. 787. 787.
787.
787, yeah.
787.
And
Close to my T-Bag level, sorry.
47.
Plus 47. Okay, good. So now we have got our accounts payable already. Yeah, let me clean up this place. And there you go. Now we can get our average account is equal to, we just keyed in here 1401, and for the previous year was 1389, and divided by cost of sales. Well, cost of sales we have already captured here, so let me just say equals to this and transfer it this here. Well, there you go. So on average we also take about 1 month credit from people, so that the net working capital cycle was about 2 months last year, has gone up a little, almost 10 days. Now when it comes to this kind of things, you know, the working capital cycle, you have to compare it with what is the industry norm. Yeah, how are other companies doing it? How efficient are they? Is 72.8 efficient or not? We don't know until we don't look at the competitor. Yeah, so sometimes you actually need industry information before you can do this. Yeah, let's look at their borrowing. They have some borrowing, we know that they do. Their total non-current liabilities equals, wait, I'm going to do a bit of cheating now, if you don't mind. So here, this is the data, isn't it? Yeah, since I'm working down there, I'm going to just cut this and put it near here lah, more convenient for us. Otherwise we are going up and down. Yeah, don't worry, none of the ratios will change. Excel will adjust by itself. Yeah, that's the beauty. I love this software. I really love this software. Yeah. Okay, so you have total non-current liabilities. There you go. Now I can just put it here. This is equal to non-current liabilities. Total equity equals total equity here total borrowings equals, where's the total borrowing? Here, total borrowing, and we have pretty much all the numbers, isn't it? Yeah, so that now if I did this, we'll get this. If I did this, we'll get this. And you can see, if I'm a corporate banker, will I call on this company? For sure. Because more than 30 times. Yeah. Here I'm not assuming this is actual ready. For the old company I was assuming net finance costs. Oh, here, so I have to put in the numbers. Yeah. What's the net finance cost? Sorry. Let's put the finance cost. I still have to go up. There you go. Finance cost 166 and 175. 166 and 175. 166. Not so perfect after all. 166 and 175. So when it comes to borrowing, they want to keep their bankers happy lah. They borrow a lot. Yeah. But they are sitting on cash buffer. So now, if you go and say to the directors, my God, y'all are paying a lot of interest, you know. Harvey told us the interest cover must be more than 10 times. Y'all are about 5.9 and 6.7. Yeah. Why are you paying so much interest to banks when you have so much of a cash buffer? The director is probably going to smile at you and say, we want to keep the bankers as our friends. Yeah, because we never know when we will have a investment opportunity and we will say to them, hey, give me some support. I must have a course of dealings with them. Yeah. So practically speaking, sometimes even big companies like KLK, they will operate with interest cover at 10 or below 10 or around 10. Yeah. But from a financial management point of view, it is not very efficient to have an interest cover less than 10, because it means that, look, your operating profit here, 981 million operating profit. They worked hard to get operating profit, and they used 166 of their profit to give profit to the bank. I think they are sharing too much of their profit with the banks. Yeah, not healthy. Yeah. So basically that's what it is. Then we have the investor ratios. Investor ratios also, you can see, are a bit thin, but I'm curious to see what the PE ratio is going to be. Yeah, because I'm working this out for the first time also today with you. Yeah, I just thought I will try something in the agricultural sector. Last time I did was Maxis, so today I say let me do something different. Yeah, there you go. Dividends for the year. Okay, so for dividends, let us go to the statement of changes in equity. Here we go. Retained earnings, dividends paid. Yeah, the dividend paid final and interim. Now, so when you have this kind of a scenario where you have a final dividend paid and interim dividend paid, I'm going to have to keep you a bit longer today. Yes, maybe 10-15 minutes. Is that okay?
Okay, thanks.
Okay, doctor.
Yes.
Okay, doctor. Yeah. Okay, let us finish our discussion. So, if I want to look at the dividends, the detail, I must make sure that in 2019 I have dividend for 2019. Yeah, and for 2018 I have dividend for 2018. And the only way to do that is to go and look at the notes to the accounts. Yeah, I would suggest don't do any shortcuts. Yeah, do notes to the account. So here I go. All the way down, notes to the accounts. Usually it is note 14, 15, around that. Yeah. Current asset, fair value. If you see the earnings per share and dividends all will be together. These are their plantations. Oh, I think I've gone too far. Equity instruments. Okay, let me go up slowly. Short-term funds, inventories, embedded finance, leases. They are given you the full story. Yeah. So you want to understand the business better? Read this. Half of your explanation will be here. Francis will be very impressed with you. Yeah. They didn't give details on dividends. I'm surprised. Let me see EPS. They must have a note on EPS. Sometimes they put it together with EPS. No, there. Note 30, note 31. Okay, I just take note of that. Dividends, they didn't put a note at all. Note 10. Okay. So maybe this is note 11. .6, 3.14. If anyone finds the note on dividend, please shout out here. There. Dividend income. This income. Yeah. Earning there. Note 11. So this is the number you have to take. Final interim together. Yeah. They are paid on the number of outstanding shares. So what is the dividend attributable to 2019? 479. Dividend attributable to 2018? 532. Yeah, this is what they have reported. So 479 and 532. 479 and 532. Yeah, thank you. Good also, no? Good payout. Yeah. Good payout ratio. Yeah. The EPS, we had it just now. The earnings per share. Here. Oh, yeah.
Below.
Yeah, below. There you go. Earnings per share here, 0.580, and here 0.572. The share price, which you have very kindly found from the internet for me, which is 2120, and I see good PE ratio, no, 36 times, strong. 43:36. Yeah, strong PE ratio. These are some of the strong counters. KLK, I know some remisiers, they have been buying KLK for like 20 years plus, and they will say, whatever I buy, I must buy KLK as part of my portfolio. I must recommend to my clients to buy. Yeah. When I do, I've been doing some training under SIDC for the stockbrokers and remisiers, and so we have some very interesting discussions on things like this. And in all these years, what I understand about PE ratio is this: you should take the PE ratio as a measure of market confidence. Is the market always correct? Obviously not. Yeah, I mean, markets are like markets. Markets are dependent a lot on the information that becomes available to the market players. So if the information available to market players is incomplete or incorrect or biased, then their response to it will also be biased. Yeah. So sometimes people call this as a measure of perceived risk. Lower the PE ratio, higher the perceived risk. That is also a fair way of looking at things. So look, these are the technical skills that you need to develop for this program. Yeah, technical skills. So please practice them. I hope that you will be able to go through this tonight, go through our discussion tonight. I am now going to do the shortcut method. If you are using a laptop, please use print screen. Otherwise, please use your mobile phone to take picture first. I'm definitely going to send it to Mr. Mohan and they will try to put it up on your portal, but please take picture so that you already have the records here. Yeah, please take picture of the screen, then go through this. Yeah,
can I have one question? For the cash and cash equivalent, right, do we actually include the short-term funds inside?
You can, if you want, you can. But today I didn't, isn't it? Today we.
Okay.
Sometimes possible lah. Yeah, it depends on how strict you want to be in your analysis or how chilled out you want to be. Yeah. Okay. Got this. I'm moving down now. Moving.
Yep, got it.
Got it, good. And now the liquidity ratios. Okay, next section, liquidity. 5, 4, 3, 2, and 1. Next, the working capital ratios.
Doctor, if you don't mind, can you go back to number 2?
You have to be quick on the draw, my friend.
No, the chat box is irritatingly disturbing my work. So I'm trying to not curse while the class is going on.
Okay, I don't know what y'all are seeing, but you can maximize the screen, you know. Okay,
Just a suggestion, if you can just go to the view options and annotate and then just click on save, you can just take a screenshot directly from there.
Is that for me to do or for your?
No. I'm just advising my fellow classmates.
Okay, good. Thank you. Okay.
Oh, just a quick question, Doc. Out of all this ratio, what would be the most pertinent in order to determine a share price for that company?
Share price? Share price is always the earnings per share, and then the market reputation. That's share price. Yeah, market reputation and share price. Yeah. So share price is not something in the open market that is worked out by numbers. But if you talk about share value, that's different. I'll talk about share value tomorrow because I'm going to talk about shareholder value. Then I'll come back to this question of yours.
Thanks, Doc. Thank you very much.
Okay, number 4, please.
Number 4, yeah. Wait. Maybe you all want to take again because some of the words were missing. 5, 4, 3, 2, 1. Okay. And here we go. Debt management, investor ratios together with the data. This one very important. Get everything.
You can see the final line, the earning per share.
Okay, there you go. There's a bit more after that though. Okay, and this is the last bit here, just a little bit, the investor ratios. Yeah. So what I'm going to do now is immediately we say good night for this class. I am going to email this to my colleague Ratna, and we will see if she can post it up immediately for you. Yeah.
Yes, it will be done in the portal, sir. It will be in the portal.
Oh, thank you. You're the man.
But you need to forward it to Ratna.
Okay. Thank you so much. Thank you.
Thank you, Doctor.
Welcome.
Thanks,
okay, guys.
Thank you, Doctor.
Thank you, Doc.
Thank you.
Thank you, Doctor.
Thank you, Doctor. Thank you, Doctor.
Thank you.
Thank you, Doctor.
Thank you, Doctor. Good night.
See all of you tomorrow.
Thank you, Doctor. See you tomorrow.
Have a good day.
Bye.
Okay.
Have a good day. Bye.
I'm ahead.
That big guy from Dubai. Don't laugh.
Very good. Thank you.